everybody. First, so we can calibrate on the audience, how many of you work in a digital health company? Raise your hand. Great, great. How many of you work for a provider system? Okay, quite a few. That's good, good. How many of you are investors or getting ready to start a company? Okay, great, great. And then how many of you are in the wrong meeting? Yeah, the cardiology myocardial infarct meeting is downstairs. So we're not going to have any of that around here. All right, so I'm Brooke Byers. It's a pleasure to be here. And when Hallie asked me to do this, I will, of course, going to say yes, because she's a hero to me and my partners, Lynn Chow, Beth Seidenberg, Larry Leisure, Dana Mead, for what she's done in digital health and her vision and foresight to start all this back when she was at Harvard and bring it on out here to San Francisco as well to serve the world. So it was Hallie's vision to have this panel today, and we have two legends, already legends, and they're still relatively young. But I think it's such a fascinating panel because these companies are very, very different. On the left with Fitbit, we have a company in one of the major trends in healthcare, which is personalized wellness and health on the consumer side, consumer facing. And then with Frank Williams at Evolent, we have an enterprise facing company working in population health and with provider systems. Just to set the table a little bit, I'm sure you all have heard, if you're in this sector, about Fitbit and Evolent, but some pretty amazing statistics. These companies, by the way, are very, very different business models. So it's not about the numbers per se comparing to the two, but just I want you to hear absolutely the numbers for each one of the companies. Fitbit, 2015 revenue guidance of $1.7 billion. That's up from 2014 revenues actual of $750 million last year revenue, and profits of $158 million. Yeah, I said profits. Yeah, that's right. 20 million devices sold to date worldwide, IPO'd in June of this year. Current market cap, 7.6 billion. We'll come back to that. Evolent, Frank Williams, CEO and founder. 2015 revenue guidance, I could not find on the web last night.
160.
160 for this year. That's up from 2014 revenues last year of 100 million. Great growth. And losses last year of 52 million. So we will talk about his business model and that. Went public in June this year. Current market cap, $660 million. These are two companies, no matter what sector you're in digital health, I'm sure you aspire to be like them. And by the way, both these companies get great ratings on Glassdoor. And Glassdoor is reasonably good. The greater the N, the better, but great ratings on that. So these are fabulous CEO managers who've built great cultures, and I'd like to get right to that. Before we get into the IPO and things like that, which is one way of seeing a milestone along growing a company, that's actually a financing step along the way, something all three of us agree on. But James, could you talk about the genesis of the company and how you built the culture of the company that you think got you to that IPO?
Yeah, so the genesis of the company, it was actually late 2006 when my co-founder Eric and I had the original idea. It actually came from the Nintendo Wii. I was a huge gamer back then when I still had time to play games. And I was just really, I remember they announced it and I waited at line at Best Buy at 6 a.m. To go buy it. And I was just really fascinated by the way Nintendo had combined sensors and really incredible software and made gaming into something that was very active and fun and positive. And Eric and I thought, how do we capture a lot of this magic and put it into a more portable form? So that was the start of Fitbit. And unlike a couple other companies I started where we pivoted all the time, the mission of Fitbit's remained the same since the very beginning. We want to use technology to help people get healthier, more active, giving them data and inspiration and guidance. And I think it's that mission that's really drawn all of our employees from day one. And that gets people excited every day, that keeps people retained within the company. And it's a very self-selecting group of people that's chosen to join us over the years.
How do you define the mission?
How do I define the mission? You know, I think the mission, people that we interview, I think are just excited to join a company that, you know, it's not just about selling ads or other things. They're actually building things and working on things every day that really help people. And they get continuous feedback from just people on the street or emails that come into customer support. So it's a very active and positive feedback loop that occurs every day, and people love being part of that.
Around wellness.
Around wellness, yep.
Yeah. I heard you say at TechCrunch last week, you make visible the invisible. What do you mean by that?
I think, you know, one of the things that we realized early on when we're working with sensors is that without, you know, instrumentation, people actually don't realize, you know, what their lifestyle's like, what their body's doing. And we were able to give people data where they could understand where they are today, what goals they needed to set, and then have tools to be able to drive to those goals. And so that's a big part of the focus at Fitbit is not only the gathering of the data and making the awareness possible, but then the tools to allow people to understand where they need to get to.
Mm-hmm. Great. Frank, so you came from the advisory board. When you and I talked last week, you used the word culture at least 10 times. What do you mean by that? Can you make it more specific? What is the one what's the culture you're building?
Yeah, and first of all, I'll say I definitely have Fitbit envy on lots of different levels. It's a lot easier to explain at a cocktail party what Fitbit is. It's a lot cooler. He's got a very cool watch on, and meanwhile, I try to explain about value-based care, which generally puts people to sleep pretty quickly in conversation. But, you know, look, I will say that I've learned a lot from the organizations I've been a part of, you know, across the last 20, 25 years. And one of the things I learned from the founder of the advisory board and I observed with people that I worked with is that people want to wake up every day and love what they do and believe in what they do. And I think a lot of companies lose sight of that, and it does. It becomes about things like revenues and EBITDA that really don't matter in lots of different ways when you think about someone's personal commitment of giving, you know, 5 days a week or 6 days a week to what they do. And so, first of all, I think mission really matters. You know, what are we trying to do as an organization? You know, the mission at Evolent is to change the health of the nation by changing the way healthcare is delivered. That's a really bold statement, and we actually thought a lot about, is it too bold? Is it too unrealistic? And then we realized that no, it's not too unrealistic. And that aspiration is the reason we've attracted a lot of people who've been in the industry for a long time and have been incredibly frustrated that they haven't been able to have that impact. So a lot of the way that we frame our growth and what we're doing is around impact and mission, and if we do increase revenues and if we are able to continue to finance the company, then we really can have an impact in 50 states and hundreds of markets and on millions of patients. So I think that's important. But more than just mission, we're very specific about our values and the way we are going to behave, the way we're going to treat our customers, the way we interact with each other. And I think that becomes amazingly important because, as we all know, we've been in this situation where you have an open position, you desperately want to fill it, you meet somebody who's really smart, but you can tell they're not of your values, that they're not going to treat people the way that you want people in the organization to be treated. They're disparaging customers or the industry or others. We make a pretty firm decision that we're not going to include those kinds of people in our organization. And ultimately, you know, what I try to frame to people is, you know, the IPO in many ways is meaningless to me. What's meaningful to me is looking back 5 to 10 years from now and saying, we've truly built an extraordinary company, and extraordinary on all dimensions. You know, hopefully we're offering, you know, an incredible service for our customers and having an incredible impact. but also the way we work together, the performance culture, that's really the aspiration. And what I've learned is when you build that kind of aspiration and deliver on it, great people want to be a part of it. And if you have a reasonable business idea and you're able to bring in the best people, then hopefully that's actually the way you win and differentiate in the market.
If we stay on this, how do you get people to sign up for your bold idea? Because health systems converting to ACO, which is fundamental to your model, right, is still happening. Not in light speed, maybe slow motion or whatever. So there's still a perception that going ACO model, risk sharing and all of this, you have 20 customers under contract, something like that, mm-hmm. Right. So how do you recruit people and get them to sign up what is not an obvious business model?
Yeah, look, I mean, I will say that from my advisory board background, everything that we do is research driven. So we didn't launch the company on a whim. We went out and talked to 150 health system CEOs about where the world was headed, what their up at night issues were, what their needs were. And so first of all, it's being very grounded in the industry and the customer base and where it's going. And as an entrepreneur, you don't have perfect visibility, but you've got to believe, hey, are the winds behind us in terms of what's going to happen? That's number one. Number two, I think real customers. There's nothing better for a business than having real customers that you're serving where you can gain experience and people see, wow, okay, we don't know exactly where the world's going, but we're actually getting experience. We're learning from that. We're applying it going forward. And look, I have nowhere near the revenue growth of James's company, but having been in healthcare services for a long time, and we just had our 4-year anniversary, last month. When you're able to get above $100 million in revenue in 4 years, I mean, my belief in all organizations, and I see a lot way underinvested, but revenue is everything. It's what builds confidence, it's what builds belief in an organization. And so our emphasis on how do we get out to the market, how do we get new customers, how does that become a big part of what we do, because revenue is contagious and then everyone begins to believe. And look, and lastly I'll say is we try to be honest and transparent about here's the great things about the business, here's things we need to work on. And I feel that people are pretty smart, and if you're having a real conversation with them about the fact, look, we don't have it all figured out, we don't have a perfect crystal ball, I think people get it, and yet they want to be part of the broader vision.
I love it. Do many of you know the name Bill Campbell, the coach of Silicon Valley, right? Bill Clariant worked at Apple with Steve, helped build Intuit with Scott Cook, went to Google as coach of the management team. That your comment about revenue, I hope you all write that down. Bill has a quote that he told me 20 years ago and it stuck with me, and I've probably used it 1,000 times since then. Ship something. That's what he says. When you're in a startup and you're early on, ship something. Just maybe it's a service to a customer, or maybe it's a product. There's a legend that James Park's first Fitbit was on balsa wood. Is that true?
It was a demo at TechCrunch, so it was.
But you shipped it.
Well, we didn't ship that. Although we had a tough time keeping, because when we announced at TechCrunch, we told people Christmas. This was in September, and it ended up being Christmas the following year. So I had a year of, this was pre-Kickstarter, and I believe we pioneered the art of being late with hardware projects. But I basically had to spend a year kind of keeping the masses happy, posting entertaining things on our blog and photos and things like that. So it was kind of interesting.
So that comment on hardware, so let's go back. Your company was started in 2008?
2007.
2007. So I hope you all can remember back then. Back in 2007, you did not start a hardware company. If you came with a hardware plan to venture capitalists, you wouldn't even get offered coffee. But John Callahan saw the vision and did it, and this was the big step of James and the vision to do that. Today, what would you say to people who want to start a hardware company? What's a good way to get going?
Today, I think you definitely need to get some type of validation from Kickstarter or Indiegogo. I think it's probably going to be pretty difficult to get funded otherwise. And you probably want to know for yourself if customers actually want to buy what you're developing. So that's probably the key bit of advice. I'm not necessarily sure that you need to have hardware background. Actually, Eric and myself knew nothing about hardware when we started the company. I think I might have taken one digital circuit design class in college. But both of us, I think, are really active learners, and we were just excited about the prospect of learning a completely new field. So that's what drove us in the early days.
So could we get your thoughts on culture, what you built in? And I'd like for you to weave into that the question a lot of people in the audience who were here asked me to ask you. Are you a consumer electronics company or are you a wellness company?
Okay. I think the culture of the company probably reflects a little bit my own personality. I like people to be pretty collaborative, trying to minimize politics whenever possible, although as we get larger, it's probably going to become more and more difficult. And I think part of that just lies in the fact that we've tried to, wherever possible, give people very clear roles and responsibilities. And I think that helps a lot. Obviously, there's places where things overlap or people are very ambitious and want to do what's best for the company. And in those cases, we just have to navigate it on a case-by-case basis. And so I think those things have served us pretty well over the years. As to what type of company we're, it goes back to our mission. People might think of us as a consumer electronics company, but our mission's much broader than that. It's more about digital health and technology and using these digital tools, whether it's hardware or software, to help people achieve their goals.
Mm-hmm. So what does that say about future products? So you have 8 or 9 SKUs now. Mm-hmm. You did an arrangement with Tory Burch. I tried to get that product in time to wear the jewelry part, but I couldn't get it in time, sorry. So I got to go with but are you going more fashion? Are you going more as a social network? What would that be?
Yeah, so one way we look at the company is that there's 5 key areas that we focus on: activity and exercise, sleep, nutrition, weight management, and stress management. So, our product roadmap is really geared towards both hardware and software solutions in each of those areas. And we're pretty agnostic about whether it's hardware or software. It just has to deliver what the users needs to achieve their goals in each of those areas. From a higher level, definitely to achieve our goals, we need to develop more and more advanced sensors. And to make these products more part of people's lives in the mainstream, fashion's definitely going to be a very important part of that. We've had a very successful partnership with Tory Burch. And it was actually Tory and her team who proposed the partnership in the beginning, because a lot of the staff at Tory were avid Fitbit users, and they said, hey, why can't we have pendants and bracelets, et cetera, to match your lifestyle. So that's how that partnership got started. And you'll probably see more collaborations like that in the future. Again, that one was so popular, I think when Tory announced that line on her website, it ended up getting sold out in about 3 hours. So it was really popular.
What % of your revenue do you spend on R&D?
It's in the high single digits. And on an absolute basis, we've doubled R&D spend year over year. This year, probably it's going to be a little bit north of 100 million. So pretty significant amounts. 2/3 of that actually goes to software development, and 1/3 goes to hardware development.
And what % do you revenue you spend on advertising?
That's been inching up. So historically, it was actually below 10%, and that reflected the fact that in the early days, we were just very efficient in the way that we marketed. For instance, Fitbit, you can almost consider a fitness social network that's being monetized to the sales of hardware. And what I mean by that is, people compete with friends and family on our platform, and that just leads to viral growth, word of mouth. Just like any other social network like Facebook, et cetera. So that really accelerated our growth. We also focused a lot on channel marketing with our retail partners. That's also a very efficient way of building your brand. And it was only in Q4 of last year that we started investing in traditional TV, print, cinema, and we've seen those to be pretty successful. So we've continued to spend traditional media dollars in the US, but we've also started spending pretty significantly on TV in a few key international markets as well.
It was in 60 Minutes Sunday night when Charlie Rose was interviewing Putin. Fitbit's in 47,000 stores in 55 countries. Mind-blowing, mind-blowing. So we're supposed to talk about IPO. So Frank, how did you manage the IPO process from a company point of view so it wasn't disruptive to the company?
Yeah, I think it is a big problem if the whole organization gets distracted and is spending time worrying about the IPO process when in reality you still need to grow, you need to serve customers well. So I think we did our best to concentrate really the work of the IPO in a relatively small group. You know that you could go through the process and it may not happen, so it was setting expectations with the organization that, hey, this is something we're thinking about, but let us handle it, and a little bit of trust us, and we'll continue to communicate so that it doesn't end up being a major distraction. So that's really what we did. We then tried to not make it a giant celebration moment, but definitely one that was a milestone in the company's history. So we tried to include people, really in the celebration, but a lot of the discussion was really around this is a moment in time. It's one moment towards our ultimate end goal of having a big impact on healthcare in the United States. Let's celebrate for a moment and then let's get back to work. And that's really what we tried to do in the process. And I think it went quite well from that perspective. I don't think we took our eye off the ball when it came to what we needed to do as an organization.
And how did you celebrate as a company?
Well, we did something fun, and we had a contest internally. We couldn't have everyone come up to be on the floor of the New York Exchange, but we had a contest. We allowed people to sort of write about their Evolent experience, and we ended up putting people on a bus, about 75 people, and having them come up to New York for the night before and the day, which is it is a really cool day particularly on the New York Stock Exchange trading floor, and then in all the offices. We wanted to give people a sense that we were at their service and so appreciative of what they'd done. So we set up some TVs so they could watch the opening, and we made pancakes and eggs and served everybody, and then had a few little happy hour celebrations that day, and that was really it, and then we moved on.
You served pancakes and eggs?
Yes, we did, yes.
All right, that's leadership. Right. That's setting a good example. And then, James, how did you manage it?
I think that the good thing for us is that the company, for many, many years leading up to the IPO, was pretty low-key, and we flew under the radar. So I don't think there were any external expectations for us going public anytime soon. And similarly, the employees really didn't expect it. So it's not a topic that was really discussed within the company. In fact, I think when we did the bake-off with the bankers, all the banking teams are really surprised as well by our numbers. And so I would say that we kind of sprung it on the company. There were a very small group of people who did all the planning in the early days, all the work to get the systems in place. And literally, I think we told the day that employees knew was the day when our S1 went public. We really didn't give any major hints before that. So it was a pleasant surprise for a lot of people in the company, obviously. And it was a great event, but for us, we just wanted to treat it as another financing event. And we had some of the early employees and senior execs come out to New York to ring the bell, and then we had celebrations in each of the offices early in the morning. So I think for the San Francisco office, it was like people had to come in at like 5:50 a.m. So, but I saw the photos, so it was pretty well populated. And during the road show as well, Bill Zarella, who's our CFO, and I Bill wrote some, email updates about what was going on in the roadshow, how the investor pitches were doing, posted a few photos. I think my favorite one for me personally, so I'd never flown on a private jet before. And during the roadshow, like the bankers just keep, because you got to travel to all these cities such a rapid period of time, so they pay for a jet. And I was super excited. And I remember in New York, we got Smashburger delivered to the jet. So we had, that was a specific request of mine. So it was a very delicious meal.
By the way, the bankers made sure you paid for that jet, just so you know.
Yes. It all comes.
Yeah, that does not come out of the 7%. Right. So it's a financing event, but it is transformative because now everybody can be your analyst. Analysts on Wall Street, analysts who write blogs, people on Twitter, all the naysayers, all whatever. So now you went from low profiles to high profiles. So I got to do my job and ask you some of those questions that people are curious about. So Frank, you went public with $100 million revenue last year and $52 million of losses. You're not profitable this year. How do you think about and explain building a high growth company that's still losing money?
Yeah, I mean, look, I would say this. I mean, I think the things we've tried to convey to people are, one, this is probably the largest market opportunity I've ever come across in my career that's wide open. It's a wide open playing field. However you size it, it's a $40, $50 billion market and pretty massive transformation that's going to happen over the next 10 years. So one is getting people excited about the opportunity. Second is there aren't too many companies that go from 8 million to 40 to 100 to 160. And so it was really important that we were delivering on the top line so people could see the growth. They could therefore believe in the market story. And then the second piece is we're not just investing recklessly. So the ability to show people that if you took the sort of economic characteristics of our most mature clients, you could see significant profitability developing as you really began to scale over time. So people could understand we're going after an enormous opportunity, transformative. We need to build infrastructure and scale. If you think about a national company managing millions of lives in a very different way, and here's what you're going to get out the other end with the growth. And people, of course, asked us, when are you going to break even, which we felt comfortable saying in 2017. Towards the end is when we feel comfortable and really explain that that was part of the business strategy from the very beginning. So we could have gone small with a niche product and delivered, probably financial returns on the bottom line much faster. But we stepped back and said, God, given the market opportunity, we should go big. And the reward for going big and finding ourselves with a broad platform and the market leader in the space 5 years out is well worth the investment opportunity. And the good news is most people accepted that story.
Mm-hmm. How long are your contracts with the customer?
So our contracts are on average 7-8 years in length. Yeah. And so there is a huge recurring revenue element to the business, which is very important in terms of creating, again, scale and sustainability over time.
Yeah. So I'd make the observation that if you had decided to raise $170 million or whatever you got out of the IPO privately, those investors would have said, go ahead and lose money and go for it. So I think you then have got to deal with the public markets and all of that. But a famous quote from Art Levison, who was CEO of Genentech, when he decided to not kill Avastin, this was about 7 years ago. One of their largest products, it turned out to be a Genentech, now a $5 billion a year drug saving lives, had a clinical trial that came out, questionable data for breast cancer. Some of you may remember this. Wall Street were beating on him, kill Avastin product, kill Avastin product. He didn't, he refused to do it, and it's gone on to be a big winner, and had that approved in Lucentis and I think Tarceva, a hat trick all in 1 year, approved by FDA. And he had a famous quote. He said, you get the shareholders you deserve. And he also said, I'm going to manage the company correctly. I'm going to manage it the way it should be managed, and whoever wants to be my shareholder on the ride, welcome aboard. And I know that sounds arrogant, but if you know what you're doing, if you believe in your business model, I think that's what you have to do. And if the board decides you're not the right person, then you're going to be replaced. But every company needs a leader. So James.
Questions from the attendees.
Okay, James, are the shareholders, are you getting the shareholders you deserve? And the question for you from people curious about your company is that there's some data that shows that the engagement and adherence of use to the products is about 50% after 6 months. Is that accurate? That 20 million have been sold, 10 million still being used? How do you guys analyze that data? Because people are going to start tracking you on that metric and on active users. I don't know if you use daily active users, monthly active users. What are your metrics?
Yeah, so we don't really publish, other than active users, any deeper metrics than that. But I guess my response would be, if you would like to judge us on engagement metrics like a social network, then it would be great to be valued as a social network with 10x revenue multiples. So I think that's a fair trade-off. But overall, definitely engagement is a big focus at the company. And there's a couple things that we try to look at like any other social network, which is one, graph density of people's friend networks. So we actively try to increase the average number of friends that people have in our system. And then also the engagement that stems off of that. And why the average number of friends is important is that we've observed that with every friend that you add, actually you end up walking more as well. I think it's about 500 to 1,000 steps per day per friend, up to a certain number of friends. So you can't add like 10,000 friends and expect to be walking, I don't know, across the country with that. So those are kind of the two things that we focus on. And again, a lot of our focus is on the software. 2/3 of our engineers are software versus hardware. And I think that's going to be the key for us as a company to really drive our growth and sustain our momentum over the coming years.
But this discontinues or falling off, that gets to the question of you have 80+% market share right now, but Apple, Samsung, Misfit, all of these others are coming on. Still, I think people are wondering, maybe for your products and all the other products too, how do they not have a 50% fall off?
In some ways, I can't talk to our competitors, but in digital health and wellness, if you look at what came before these products, like home gym equipment, gym memberships, et cetera, the retention, utilization of those services and devices, pretty atrocious. I think I read somewhere that, half of gym memberships are actually never really used at all. And I think most home gym equipment ends up just getting abandoned. So I think the fact that these devices are already starting off with what I feel is pretty good engagement, and with continued investment in software can get better over time, I think bodes really well.
Okay, we have some questions from the audience I want to get into. Now, post-IPO, employee retention and recruitment. So what do you do about the employees who now are vested or pretty much vested? Your stock is public. They're getting calls from recruiters. You've got a lot of talent there, and people want to poach your employees. What are you going to do about it?
Well, I'll just say, we spend a lot of time on building a world-class environment for talent, and a place that people can come into, have really stretch roles within their careers where they're working with the best people that they've ever worked with. We focus a lot on communication. We're doing engagement surveys every 6 months, and in every engagement survey, we find things that we can work on and be better about. So I think a lot of the basics that we talked about what's the mission, what are our values, what are we trying to do together, where the economics are one component of that, and clearly we need to have competitive financial packages going forward for people, but where the whole proposition is winning and incredible, and people are excited about what they're doing. So we continue to place emphasis there, and as a result, our retention rates have been incredibly high because it really is about the long term and getting people to believe in that.
For us, again, I think the mission of the company, of Fitbit, really allows us to attract a great set of people. And as Frank mentioned, economics is a part of that. But for us, actually, I find that on the economics bit, it's been a bit easier after the IPO because for a long time, the valuation of Fitbit was actually pretty low, and we didn't want to oversell what the value of our options were. And so when you're competing against companies with really lofty private valuations like Uber, et cetera, it was actually pretty challenging because, I wouldn't want to say that it's disingenuous, but I think it's unfair to, I think companies a lot of times use what the preferred stock valuation is and assume that, that's what the employees are going to get, which again, I think is pretty disingenuous. So now I feel that the difference is still there, but given our valuation, it's been a lot easier for us to compete on the economics basis.
Oh, you're $8 billion versus Uber's $50 billion.
Well, now we can
Market
actually
cap
put a
wise.
value on the stock. Before it was like, what is the stock worth? We don't know. Please don't look at our last round because that was really low. And yeah.
Right. So another question from the audience is, now that you're public and you have to report quarterly and you have to do all that stuff, are you going to take less risk?
I don't know if I'd say take less risk. Look, the reality is when you commit to the public markets and you put out expectations, you need to deliver against those expectations. You're building trust with your shareholder base. So I do think that we make a big deal about trying to meet our commitments. And if I felt like we suddenly needed to do something that went well beyond the commitments that we made, I'll be honest, I wouldn't do it in the moment. Now, I might go back to the market and explain, here's the opportunity that we see, here's the investments that we're making, and still be willing to take risks, but you have to do that within a reasonable set of expectations. So, we've thought about this, long and hard. Where's the business? What are the trade-offs we're making? Do we think we can still build a great innovative business and operate within some of what we know the parameters of Wall Street to be, and we felt that we could. But I'd be disingenuous if I said you don't have to factor those things in terms of expectations that you've set. I can't suddenly decide right now I'm going to just throw $30 million into the fourth quarter and then coming back and try to explain it later, because I've already set those expectations.
Your business is very complicated and hard to be in, so I don't think there are going to be a lot of people rushing in to compete with you. But James, there are a lot of people who want to compete with you, big and small. So how would you answer this? How are you going to manage this?
Yeah, looking at our product pipeline, I don't think that we're taking fewer risks than we did before. And the risks that we're not taking, we probably shouldn't have ever been taking in the first place. So I think that discipline is really good. And we look at all the bets that we want to make over the next few years, and that's all kind of built into our guidance. And that's, I think, generally how we want to run the company.
So let's thank James and Frank for coming today and being at the summit.